Welcome to the Deep Dive. Today we're plunging deep into the 1980s, a decade that, well, it didn't just change fashion, did it? It fundamentally rewrote the rules of American capitalism.
It really did.
And beneath the surface of, the big political shifts and early globalization, there was this financial earthquake happening. It was all fueled by a revolutionary and, frankly, highly controversial way of funding corporate takeovers. We're talking about the high-yield revolution.
That's absolutely right. We're zeroing in on that dramatic shift in finance, in corporate power, that happened when a whole new set of financial instruments came along.
Right.
And the people championing them, like Michael Milken and his firm, Drexel Burnham Lambert, they basically allowed outsiders to challenge these huge financial institutions that had, governed corporate America for nearly a century.
Wow.
This was truly the birth of modern high-stakes leverage, and just the sheer audacity of it all, that's what makes this history so critical for understanding, where we are now.
Okay, let's unpack this transformation then, because to really grasp how radical Drexel and high-yield finance were, we first have to appreciate the power structure that came before it. Our sources call this the baronial age of finance.
The baronial age, yeah, it's a perfect description, isn't it? It evokes this immense, almost feudal power held by firms like the House of Morgan. During this time, which, it lasted well into the 20th century, bankers didn't just facilitate deals. They basically acted as a kind of centralized governing body for huge parts of the American economy. How? By allocating scarce credit.
So they were the gatekeepers of money.
Absolutely. If a major company needed capital, it didn't just go out to the public or, a bunch of different investors. It went to these powerful financial backers, and they decided who got the money and who didn't.
And that relationship, it wasn't just about the money, it was about control. Companies became intrinsically linked to their financial backers. We see this so clearly in history. The New York Central Railroad, for example. People often called it a Morgan Road. That wasn't just a nickname, right?
No, not at all. It reflected the deep influence of J.P. Morgan and his successors. They effectively treated these railroads almost like extensions of their own financial empire.
Incredible.
Yeah, the bankers were integral to how these companies operated because their stamp of approval, it was kind of like a credit rating today, but honestly way more powerful.
Okay.
Before widespread government regulation of securities, Pierpont Morgan's endorsement, that was the guarantee. That's what reassured all the major investors.
Right.
Our sources talk about how Morgan successfully recreated the combined power of all those dispersed shares in the New York Central, putting his, quote, golden manacles on the railroad.
Golden manacles, wow.
The House of Morgan would recommend investments in that railroad constantly, very strongly, making sure their vision for the company won out. It was a system built on trust, hierarchy, and extremely limited access to capital.
So you've got this old system, power centralized, concentrated in the hands of a few established, often, very traditional firms. But then right as the 1980s kick off, there's this huge political shift happening that creates the perfect conditions, the perfect incubator, really, for the new guard to crash the party.
Precisely. You see the conservative revolution just gaining unstoppable momentum across the globe. It starts with Margaret Thatcher in Britain in 79,
Right.
followed by Ronald Reagan here in the U.S. in 1980. And this political turn, which was fundamentally about deregulation, combined with increasing financial globalization through the decade, it just accelerated the growth of capital's share in the economy.
Which seems to perfectly set the stage. It's like the ideology of the decade was deregulation gives you permission. And debt gives you the leverage to actually tear down the old guard. It was almost like a cultural and political permission slip to start dismantling established structures.
That's a great way to put it.
And that brings us right to the primary weapon used in this revolution, the leveraged buyout, or LBO, which, as we've hinted, was powered almost entirely by this high-yield or junk bond market that Michael Milken was busy building.
And it started so quietly, didn't it? The LBO, it began life as something called the bootstrap deal. It was actually a form of assistance for, elderly founders of family-owned companies.
Really?
How so?
Well, they needed a way to get cash out of their businesses without getting hit by massive estate taxes when they died, but they also wanted their families to maybe keep some control, a minority stake. It was basically an internal estate planning thing.
That sounds incredibly mundane, like worlds away from something that would eventually unleash chaos on Wall Street. So what was the core financial mechanism? What was the game changer that let it evolve from, a polite tax strategy into this massive takeover tool.
The core mechanism was the radical use of debt, specifically massive debt financing that leveraged the assets of the target company itself.
Okay, wait. Break that down. Okay, so this is the crucial bit. The acquirer, the person or firm buying the company, didn't actually need to put up most of the cash themselves.
Right.
The deal was essentially financed by a new source of capital, these high-yield bonds, that used the target company, the one being bought, as collateral.
So the target company basically paid for its own acquisition.
Pretty much, yeah. And crucially, this debt was non-recourse to the acquirer's own balance sheet. The risk was largely on the target company.
That is the ultimate financial sleight of hand, isn't it? The target takes on crippling debt, becomes its own collateral, and the raider walks away relatively unscathed if it goes wrong.
In theory, yes, though obviously reputations were on the line. But to pull off these multi-billion-dollar takeovers, you couldn't just borrow from the old banks, the Morgans of the world. They wouldn't lend that aggressively, not for this kind of thing.
And this is where Michael Milken and high-yield debt become absolutely essential.
Absolutely. The established banks, they'd only lend to investment-grade companies, the blue chips, right? This left this huge untapped market of medium-sized companies, maybe riskier ones, or just companies that weren't rated investment grade. Their bonds were dismissed as junk.
Okay.
Milken's key insight, his genius really, was arguing that while any single one of these companies might default, a diversified portfolio of these bonds actually offered a better statistically predictable return than the rating agencies were giving them credit for. He argued the market was fundamentally mispricing the risk.
So he didn't invent the junk bond per se, but he industrialized it. He created a liquid, tradable market for it.
Exactly. He made it possible to raise billions through these bonds very quickly.
And the genius of the LBO model, fueled by this debt, was that it could create profitability even with that intense leverage.
Yes, and you see the immediate impact. Our sources point out this perfect contradiction. Warren Buffett, he famously, denigrated the underlying high-yield junk bonds fueling these deals, called them dangerous, unstable.
Right, I remember that.
But he still opportunistically arbitraged the takeovers that were executed using them.
Wait a minute. He hated the instrument but loved the outcome. Tell us more about that arbitrage opportunity. That sounds fascinating.
Well, it just highlights how unavoidably profitable the takeover structure itself could be, regardless of the debt underneath. Because of the extreme leverage, when a high-profile takeover was announced, especially a hostile one, the target company's stock price often dipped temporarily. There was a market discount relative to the actual deal value because of uncertainty, the time needed to get financing, all that.
Okay.
So shrewd investors like Buffett could swoop in, buy the stock at that discount, bet on the LBO successfully closing, which it usually did, thanks to Milken's financing machine, and then pocket predictable, enormous profits when the deal finally went through.
Wow. So his arbitrage actually proved how central this high-risk financing had become to the whole takeover scene, even if he didn't like the bonds themselves.
Exactly. It was undeniable.
And the firm that just aggressively championed this, monetized it, basically democratized this new high-yield market was Drexel Burnham Lambert. They weren't just playing the game. They were like engineering a whole new financial environment from that infamous X-shaped desk in Beverly Hills, right? Far from stuffy old Wall Street.
Oh, completely. Drexel's ambition, especially driven by their CEO, Fred Joseph, it was revolutionary. And it was explicitly aimed at challenging the establishment. Joseph kept emphasizing Drexel's rapidly growing capital strength, its financing capability, and contrasting it with establishment firms like, say, Kidder, Peabody, which just didn't have that access to deep, decentralized capital. Drexel essentially made financing mega deals available to pretty much anyone who was audacious enough to try, whether they had old school connections or not.
So it was a deliberate strategy. Invade the territory of the old guard.
Yeah.
Joseph wanted to extend Drexel's client base right into that blue-chip establishment territory that the older firms saw as their birthright. He was giving the financial firepower, the fuel, to these corporate outsiders, letting them attack the very companies the Morgan Roads once governed.
And Joseph saw the future pretty clearly. He argued Wall Street would soon be dominated by just a handful of really capital-rich firms.
Right.
And by democratizing access to massive debt through high-yield bonds, Drexel was actively engineering that future, making sure they were one of the survivors. They successfully dismantled the old idea of scarce credit, replacing it with democratized high-volume debt that anyone with a convincing plan and Milken's blessing could tap into.
So once Drexel proved you could industrialize this debt, the financial establishment pretty much lost control. Boardrooms turned into battlefields.
Yeah.
Now we get to the really dramatic consequences of all this readily available leveraged capital. This unleashed just a historic wave of corporate takeovers where even the biggest, most established giants were suddenly vulnerable to attack.
It truly was an extravaganza. I mean, this LBO era set the stage for one of the greatest periods of merger and acquisition activity ever. And even looking ahead into the next century, the appetite for financing these record-shattering mega deals, it just kept growing, fueled by the infrastructure created back in the 80s. You see it later with figures like Jimmy Lee, who perfected debt syndication at firms like J.P. Morgan, funneling hundreds of billions into LBOs in the mid-2000s wave. The 80s gave us the template, the belief structure.
Now, the LBO machine was, and still is, often slammed for creating dangerously over-indebted companies, leading to failures, job losses. But the analysis of the LBO debt itself, it's maybe not quite that simple. Our sources suggest something interesting. While the debt was huge and the risk immense, LBO-owned companies actually defaulted at lower rates than similarly leveraged companies, at least during periods of economic expansion.
That's a crucial point, almost paradoxical, isn't it? It challenges that popular narrative of just reckless greed. It suggests that aggressive leverage could actually be highly profitable and surprisingly stable when done strategically.
Why, though?
Well, arguably because the new debt-driven owners were incredibly incentivized to manage the assets ruthlessly efficiently.
The debt burden forces discipline.
Exactly. But let's be clear. We were told this was reckless finance, and culturally it was jarring because that efficiency often came at the expense of employees and, long-term corporate stability.
So economically, maybe not always reckless, but the social cost could be high?
It was both, really. Economically, the new owners were often superior operators, forcing painful but maybe necessary streamlining. The goal of LBO ownership wasn't really long-term stewardship. It was maximizing the return on the asset in a pretty short window, often by cutting expenses and selling off parts of the business.
Okay.
But we absolutely cannot ignore the painful consequences. While maybe only a small fraction of these LBO companies actually failed, the ones that did often resulted in brutal job cuts, severe disruption to communities. Even when they succeeded, the pain was typically felt by the workers, not the highly paid managers or investors.
Okay, to really feel the intensity, the high stakes of this new leverage market, we absolutely have to talk about the LBO war that defined the era. The fight for RJR Nabisco. It sounds less like a business deal and more like a corporate civil war fought with billions in borrowed money.
Oh, the RJR Nabisco case is the perfect, just visceral illustration of how personal, ego-driven, and frankly venomous these deals could get. The fight basically pitted the established private equity titan Kohlberg Kravis Roberts, KKR, led by Henry Kravis.
Right, the big name.
Against the management group of RJR Nabisco itself, led by its own CEO, Ross Johnson.
And Kravis was known for being fiercely territorial, right?
Yeah.
Like he viewed any move on a potential target as a personal insult.
Absolutely. Our sources describe this moment when Tom Hill, a banker from Shearson, just casually suggested his firm might help Kravis with an acquisition. Maybe like crapped. Kravis's reaction. Immediate, intense anger.
Really?
Hill recalled Kravis's venomous tone. It revealed Kravis's worst fear, that Shearson was actually planning to move on RJR Nabisco, a target Kravis desperately wanted for himself.
Wow.
Kravis was, as the source says, loaded for bear. He saw any move on a target he wanted as a deep betrayal. He warned Shearson's people that because the RJR deal was so visible, so big, and had those perfect cash flow characteristics for an LBO,
The perfect target.
he said, we have to be in on this deal, and we will be in this deal. That kind of non-negotiable personal stake just elevated the whole battle from finance into this huge ego clash. It was a dramatic high-stakes spectacle.
And it got worse, didn't it? Quickly involved elements of, like, corporate espionage and betrayal. The bid war was apparently influenced by leaked confidential documents that just blew the management's bid right out of the water.
Oh, completely. Kravis somehow received a note revealing that Johnson's own internal valuation of RJR ranged between $82 and $111 per share.
Okay.
Yet Johnson and the management group were only bidding $75.
Whoa, that's damning.
That leak was decisive, just stunning. It made it crystal clear that someone, almost certainly a high-level executive furious about Ross Johnson's perceived self-dealing, was actively trying to sabotage the management bid from the inside.
Unbelievable.
This gave Kravis irrefutable proof that Johnson was trying to basically steal the company on the cheap at the expense of shareholders. The whole process was just fundamentally poisoned by distrust, internal warfare.
And the whole chaotic thing culminated in this end game that required financial maneuvering that was, bordering on desperation. It shows how far these guys were willing to push reality.
Exactly. The final auction process was just pure, sleep-deprived chaos. It ran right through the night. The bids got so astronomically high that the only way to possibly squeeze out a win was through incredibly complex, highly uncertain financial engineering.
Okay.
We see first Boston's Matt Rosen examining this desperation bid from his client, and he realizes the whole proposal's viability rested entirely on what he called a nasty knot of tax assumptions.
A nasty knot of tax assumptions. That has to be the most 1980s financial phrase ever. What did that actually mean? How critical was this knot?
It was the linchpin. Everything hung on it. It relied entirely on a really aggressive interpretation of the U.S. tax code. Specifically, could they deduct the massive interest payments from all that debt? And could they get favorable classification for the new holding company's structure?
So billions were riding on a tax interpretation.
Literally. The fate of the entire auction, billions of dollars, hung on whether Rosen could advise his client that, yes, $4 billion in taxes could be legally and defensibly deferred. It wasn't just about cash flow anymore. It was a high-stakes gamble on arcane tax rules. The winning bid wasn't just higher. It was arguably the most technically fragile.
That RJR battle really shows it all. The technical complexity, the personal vendettas, the ruthlessness. Okay, let's shift a bit. How did this concentration of massive capital and high leverage create an environment that was just ripe for ethical failures, for conflict?
Well, what's fascinating is how this immense, almost instantaneous flow of capital created by the leveraged environment made financial wrongdoing almost inevitable.
So,
when you have deals moving billions of dollars in just days, the stakes are so incredibly high that information asymmetry, knowing something the market doesn't know, becomes the single most valuable, portable commodity there is.
and that leads us directly into the scandals that rocked Drexel and the rest of Wall Street.
Right.
It proved that for some, the high-yield culture wasn't so much about democratizing capital as it was about instant personal enrichment. The SEC investigation into Dennis Levine, that really exposed the dark underbelly. Levine traded massively on inside information, stolen from Drexel and others.
And it wasn't just him acting alone. Levine had apparently assembled a ring to systematically buy information from other investment bankers.
Buying secrets.
Yeah. These bankers were creating confidential information about upcoming mergers, takeovers, LBOs, the very events being fueled by Drexel's high-yield machine. Knowing a company was about to be taken over, especially thanks to a Milken financing deal, was basically a guaranteed windfall. The scale of the illegal trading was just immense.
And the sudden crash after the boom, it became really palpable when Fred Joseph, Drexel's CEO, got that urgent courtesy call from the SEC's enforcement chief, revealing the massive scale of Levine's insider trading and the criminal charges that were coming.
Oh, yeah.
That must have been the moment the music stopped.
Oh, absolutely. It revealed the cost of having such high-value, market-moving information concentrated in the hands of just a few people. That phone call really was the beginning of the end for the pure, unadulterated reign of Drexel and Milken.
Mm-hmm.
But we also have to recognize this financial upheaval. It reflects a broader, ongoing economic trend, too, this concentration of wealth that economists sometimes call the superstar effect.
Yeah.
The LBO revolution was happening alongside globalization, technological change, all creating these winner-take-all economic tournaments in lots of sectors.
So these forces combined to drive greater concentration of just astronomical sums into the hands of a few.
Exactly, and our sources highlight a really critical historical shift here. If you look back, say, to 1932 France, the main source of income for the absolute top earners, the top 0.5%, was income from capital, meaning passive income rentiers, earning interest, land rent, that sort of thing.
Okay, the old money.
Right. But the rise of leveraged finance helped trigger this massive shift towards enriching active executive management. The financial innovations of the 80s made the manager, the operator, the person doing the restructuring exponentially more valuable to the shareholder. The managerial revolution, it accelerated, transforming the manager into a highly compensated capitalist in their own right.
So this is the era where the manager, armed with the power to leverage and restructure skills directly enabled by the LBO market Milken created, becomes the central financial figure. And we see this perfectly exemplified in the huge change in pay, the remuneration revolution, illustrated by, say, the GE Jack Welch context.
Welch, CEO of GE, was the absolute quintessential aggressive manager of this era. He was just determined to make GE more and more profitable, constantly emphasizing that Wall Street, the equity investor, had to come first.
The shareholder value above all.
Exactly. And this focus on maximizing shareholder return fundamentally justified compensation structures that massively rewarded executives for aggressive restructuring, cost-cutting, often at the expense of labor.
And the numbers, they're just staggering. They really highlight the socioeconomic cost of this revolution. Back in 1965, CEOs were paid maybe 20 times the average employee.
Right.
That ratio started to balloon precisely around the time Welch took over GE and this whole LBO culture took hold. It shot up rapidly 50 times, then 100 times, eventually 200 times or even more than their average employees.
It's a systemic transfer of wealth. It was a direct consequence of prioritizing capital efficiency over, say, labor stability or community ties. By the turn of the millennium, you had unprecedented corporate profits, yet pay for the average American worker. Virtually no increase after you adjust for inflation. That productivity pay gap just became a chasm. It ensured that those at the lower end struggled, while senior management, well, they never had it better. They internalized and executed this philosophy that the shareholder, and by extension the manager serving the shareholder, is king.
Okay, so if we pull all this together, these polite bootstrap deals morphing into hostile, debt-fueled takeovers, Drexel's democratization of capital turning into financial warfare like RGR Nabisco, and this resulting radical concentration of wealth. What's the lasting, the immovable legacy of leveraged finance?
The long-term impact is just profound. The leveraged finance revolution fundamentally changed who held the keys to corporate America. Control moved definitively from those traditional establishments, the old baronial age firms allocating scarce credit, to this new class of capital-rich outsiders and managers who were willing, eager even, to use debt to its absolute limit. Michael Milken's vision, however controversial its execution was, it successfully challenged the oligarchy of old Wall Street, and maybe, arguably, replaced it with an oligarchy based on pure capital efficiency.
And this cultural shift, the idea that maximum profit, often achieved by challenging old rules and taking on immense risk, is the ultimate goal. That still feels like the defining feature of finance today, doesn't it?
It really does. And you see how these power shifts resonate globally. Remember after the great financial crisis hit in 2008, after decades of this globalized, deregulated finance, figures like Vladimir Putin, who was then Prime Minister of Russia, noted that faith in the U.S. as the leader of the free world and market economy, it had been shaken, as had trust in Wall Street. And he concluded that the old system, the old way of allocating credit and power, quote, will never be restored. Things will never be the same again.
Which really raises the ultimate question for you, our listener. If the power of capital truly will never be restored to those old systems, and if every manager is now effectively a hyper-compensated capitalist, what kind of leverage and what kind of risk will define the corporate kings of the next generation? Will it still be traditional financial debt? Or will it be the leverage you get from controlling next-generation assets, things like AI power grids, digital monopolies, proprietary data that grant new, maybe unchecked, forms of advantage?
That really is the challenge we face now. When you reflect on the chaos and the sheer competition of that LBO era, you realize something about today. While maybe the pure average return on capital across the whole economy has slightly decreased, that's completely overshadowed by the growing inequality of returns on capital. Meaning the highest returns disproportionately flow to the largest fortunes, the biggest pool of capital. It poses very little threat to their overall wealth, even if the general market sort of struggles. The financial revolution of the 1980s, maybe it just changed the location and the methods, but not the existence of immense unchecked financial power. It just ensured that concentrated wealth remains the defining feature of our global economy.